$32 billion for Wiz. I seriously need to lie down. That multiple is unhinged.
It really isn't. Buyers are totally spooked by naked AI plays right now. Google had to pay up for actual cloud security.
It's a panic buy. They're just terrified of Microsoft.
Securing the perimeter isn't panic, but fine. If you want a traditional value play, we can talk about Apollo buying Japanese glass.
$3.7 billion for literal windows. Now that is my kind of drama. The rundown. $3.7 billion for Japanese glass. I absolutely love this. Apollo is looking at the map and deciding Tokyo is their new playground.
It's their biggest private equity play in Japan ever. But Nippon Sheet Glass isn't just windows, Nate. You have to look at the revenue splits. It's heavily weighted toward automotive and renewables. Solar panel glass is a high-margin necessity right now.
Still, a mega fund doing heavy manufacturing overseas feels very 2006. I feel like I'm back in my analyst bullpen formatting pitch decks for industrial carve-outs.
Except the returns are actually there this time, which reminds me of that Stepstone data that dropped this morning.
The fund performance numbers?
Right. Middle market and early stage private equity funds are currently outperforming the established mega managers on IRR. They're finding highly specific niches and exploiting them. Look at Olympus Partners.
Selling the retina business of EyeSouth to Cencora?
Exactly. $1.1 billion. Just for the retina division, they carved out the most specialized, high-margin piece of that healthcare platform and flipped it to a pharma giant. That's textbook middle market alpha.
You call it a niche, I call it an aging population cash machine, but I disagree that the mega funds are entirely asleep at the wheel. They're just looking at entirely different asset classes. Case in point, my favorite text from this morning.
The cricket rumor?
Yes, Blackstone is reportedly evaluating a massive stake in a global cricket league.
Wait, really? We're doing private equity cricket now?
Media rights, Maya. It's a live sports goldmine. Private equity buying sports leagues is the new tech pivot.
I just love the visual of a New York buyout king trying to explain a wicket to his limited partners.
The only wicket they care about is the cash-on-cash return.
Fair enough. But if we're talking about massive checks, we have to talk about the tech sector. That Equitech report claimed buyers are getting cautious about AI targets.
Which is hilarious considering the news that just crossed the wire.
$32 billion.
Google and Wiz, it's official.
A cloud security startup that's barely 4 years old. The premium Google is paying to lock down their cloud infrastructure is staggering.
My banker brain is short-circuiting at the revenue multiple. We need to unpack exactly how they justified this valuation. The big one. $32 billion for a New York-based company that was founded, 4 years ago? I had to check my terminal 3 times this morning to make sure I wasn't hallucinating an extra zero.
4 years ago, yes. And let us be very clear about the math here, Nate. Google is paying roughly 64 times forward revenue. 64. You used to pitch these deals. If you took a 64 times multiple to a credit committee back in your banking days, they would have tested you for narcotics.
Okay, fair. But you're looking at this like a spreadsheet exercise. This is an existential land grab. Google Cloud is tired of being the bronze medalist behind AWS and Azure. Wiz gives them an immediate plug-and-play security story for enterprise clients. You overpay for the missing puzzle piece when the puzzle is worth trillions.
I'm not arguing the strategic fit. I actually think Wiz has an incredible product. But $32 billion? They're pricing in 10 years of flawless execution. And Google isn't exactly known for integrating acquisitions smoothly. Remember when they bought Mandiant for $5.4 billion?
Oh, I remember.
The footnotes in this Wiz deal are fascinating, by the way. If you look at the retention packages, they're locking down the Wiz founders with golden handcuffs that are basically made of vibranium. Google knows the only way this valuation holds up is if the core team actually stays.
Which they usually don't. The founders vest, buy an island, and become seed investors. But Maya, look at the broader market. What's ironic is that everyone is obsessed with AI targets right now. But that Equitech report just showed buyers are actually getting super cautious on pure AI deals.
Right, because the revenue models are unproven.
Exactly. So where do you put your billions? You put it in the picks and shovels. You can't sell enterprise AI if your cloud infrastructure isn't locked down tight. If Google didn't buy Wiz, Microsoft would have, or at least forced Google to bid against a phantom term sheet.
Wait, really? You think Microsoft was actually in the room?
Absolutely. I guarantee you there was a banker whispering Microsoft's name in the hallway to drive up the price. It's the oldest trick in the book, and clearly it worked. 32 billion is a legacy-defining check for Sundar Pichai.
It's a desperation check. They're terrified of losing the AI cloud war because their enterprise security narrative was weak. I'll give them credit for solving the problem, but the price tag is just corporate ego disguised as strategy.
Corporate ego pays my favorite kind of advisory fees. I mean, the champagne bill alone on this closing dinner probably rivals the GDP of a small island nation.
I'm sure you're already angling for an invite.
My suit is at the dry cleaners right now. But speaking of massive cross-border checks, Google isn't the only one throwing billions around this week.
No, they aren't. Apollo is making a massive private equity play in Japan, and frankly, I think the valuation logic there is a lot more interesting than whatever Google is doing.
$3.7 billion for Nippon Sheet Glass. Talk about a pivot from software to hard assets. Voices.
I was reading the new global buyers report from Equitech this morning. Everyone thinks we're in this blind AI gold rush, but the data says the opposite. Buyers are actually pulling back. They're terrified of buying a shiny AI startup that turns out to be three guys in a trench coat using the OpenAI API.
Okay, but how do you square that with Google dropping $32 billion on Wiz? That just closed $32 billion. You cannot tell me buyers are cautious when we are seeing multiples like that.
Wiz is fundamentally cloud security, Nate. It's not some generative AI toy, it is infrastructure. That's exactly what the report is saying. Strategic buyers want actual revenue and defensible moats, not just an AI domain name.
Fair. But I still think the mega cap tech guys are panic buying. Speaking of panic, did you see the Stepstone numbers on private equity returns?
I did. The mega funds are getting beat by the rookies.
It's wild. First time and early stage PE funds in the middle market are actually outperforming the legacy managers on IRR right now. The big guys have gotten too slow. They're like cruise ships trying to parallel park. Meanwhile, these emerging managers are just picking off great $50 million targets and actually doing the operational work.
I love that for them, but let's look at the footnotes. It's easy to post a massive IRR when you have only exited 2 deals. The math gets a lot harder in Fund 4.
Spoken like a true skeptic, you just hate joy. Wait, there's one more analyst note. The alcohol M&A market is officially cooling off. Oversupply and nobody's drinking anymore.
Good. Maybe those sponsors will sober up and look at what Apollo is doing in Japan. $3.7 billion for a glass company is a massive play.
We absolutely need to talk about Nippon Sheet Glass. The corporate carve-out angle on that one is fascinating. Spill the tea. I cannot stop thinking about Blackstone evaluating a stake in a global cricket league. It's the most private equity guy move ever.
You just know some managing director got really into it during a trip to London, and now he wants to buy the sport.
Hey, don't underestimate cricket. The broadcast rights alone are printing money.
Oh, I know the numbers are real. I'm just picturing guys in fleece vests trying to explain a wicket to an investment committee.
It's no weirder than Sony nearing a $1 billion home entertainment deal with TCL. Everyone is throwing darts.
Speaking of throwing darts, the rumor mill is buzzing about Estee Lauder.
The Puig talks.
Right. Active discussions to acquire Puig to create this massive new beauty giant.
Which is incredibly smart. Estee has been struggling, and Puig gives them that high-end Spanish fashion and fragrance portfolio. It's a perfect life raft.
A life raft? Nate, it's a shiny object. They're bleeding market share in skincare and think buying a fragrance house fixes their core operational issues.
It changes the narrative.
Narrative doesn't fix margins. You know who is actually generating returns right now? Not the mega cap giants making splashy narrative plays.
Let me guess, you read the Stepstone data?
I did. First time and early stage middle market private equity funds are completely outperforming established managers. The big guys can't match their internal rates of return.
That has to hurt the egos at the legacy shops.
I'm sure they're crying into their carried interest. But it proves my point. Discipline beats drama.
Well, if you want discipline, we need to look at the financial sector in Southeast Asia.
The strategic shift towards smaller minority acquisitions.
Exactly, and tomorrow we should be getting formal regulatory updates on Grab's pending $600 million acquisition of Food Panda's Taiwan business. Tomorrow's radar. Tomorrow morning, I'm refreshing the regulatory portals for the Grab and Food Panda filings. $600 million for the Taiwan business. It's a classic land grab. Pun intended.
Please tell me you didn't plan that pun.
I absolutely did. The Southeast Asia playbook is shifting. Everyone wants global mega deals, but the smart money is moving towards smaller minority investments.
I have to push back. $600 million for a regional footprint isn't a small minority investment. But what I'm actually watching tomorrow is the new Equitech report.
The one saying buyers are getting cold feet on AI?
Exercising caution, not cold feet. Buyers are finally realizing half these AI targets are just 3 guys wrapping an API in a slick interface.
Fair. You know what doesn't need an API? Cricket. Blackstone is supposedly evaluating a stake in a global cricket league.
Wait, really? Blackstone doing cricket?
Private equity is coming for the wickets. We'll see if the math bowls them over.
We're ending on that terrible pun. Catch you next time.